So, obviously, the market's had ups and downs through the years. This seems to be a rather unique situation since we're dealing with a health concern that really nobody knows how this is all going to shake out. What would you tell your clients about the market?
Well, so that's interesting that you say it's unique because everybody feels like it is. But the fact is that in this century, since 2003, the first virus outbreak that we didn't know anything about, we've had five. We've had five virus outbreaks that we thought were going to take us down since 2003. The markets, the equity markets have quadrupled since that time. There's no reason to think that this is going to be that different. I mean, it's a very big scare. People want it. Governments are trying to contain it. They're doing everything they can, and that puts fear in people's hearts. The market, the Dow Jones Industrial Average, was bumping on 30,000, which is a big number, and it's a big hurdle. Just like 20,000, just like 10,000, both of those, it was hard to get past that. So investors were looking for a reason to sell off and justify the fact that they thought 30,000 was too high. And here comes the coronavirus. And so I think it's pretty typical markets as usual. The fact is that we're in a market correction now. We may have a bear market, but honestly, we've had 10 market corrections this century in 20 years, one every 2 years. We've had 3 bear markets. We have one about every 4 years in the last century. So none of this is really anything other than normal market activity. And so I think the thing is to take the fear out of it and quit listening to the fact that there will be short-term ramifications from the coronavirus, but not long-term. So what I tell our clients is this is a great time to look at your time horizon for your money. And if you need money this year, this is probably not a bad time to shore it up and put it in cash. If you need money 5 years from now or 10 years from now or 20 years from now, which is what most people invest for, there's really nothing that's changed that trajectory. There's nothing that you would look at that says you shouldn't be doing exactly what you were doing a week ago before all this happened.
So you're saying, let's say somebody's going to retire in 5 years.
Right.
Your advice to them is what?
Well, unless they plan to die the day they retire, which most people don't, they're going to retire and have 20 years, something like that. So now their time horizon is 25 years, right? Well, in 25 years, the least downside risk that you can take in the markets is equities over a 25-year period of time. The problem is you have 25 one-year periods of time where it's the riskiest investment. So you have to get through those one-year periods of time. But the fact is you keep your eye on the ball, and time horizon is the most critical factor in portfolio construction. How long do you have? Because if you have 1 year, 2 years, or 3 years, what is risky is much different than if you have 10 years, 15, or 20 years. And so if you want to be safe, it's a whole different ballgame 20 years out than it is 5 years out. If you want to be risky, there's a whole different ballgame 20 years out than 5 years out. And so really just trying to figure out where you are in that cycle, that money cycle, where you need money and where you don't need money, and what it's supposed to look like is the key to this. And so it's a great time to say, hey, I haven't done this in a while. Let's look at our time horizons for our money and make sure we're in the right place. But it has always been a fool's game to chase returns, to chase down markets, chase up markets. And so, long-term vision means more than short-term fear.
Okay, so what about? Okay, you're all in and staying in the market. You understand that,
right?
What about the portfolio as far as investing internationally versus domestically? Do you change that?
So this is what I would say about that. The last 10 years since the Great Recession, U.S. markets have done better than any other markets in the world. But that is not normal activity over 20 and 30-year periods of time. The fact is that over 20-year periods of time, rolling 20-year periods of time over the last 100 years, there hasn't been one where it didn't add to your portfolio to have international equities. International equities make up currently about 46% of all the equity choices in the world. So when you say I don't want any of those, you're saying I'm just going to exclude half the choices in the world because I don't want to. And you're saying that the Toyota, Mercedes, Nestle, all these foreign companies aren't worth having because they're foreign, and that's just not true. And so we're a reversion to the mean business. If the U.S. has done well and foreign investments haven't, probably that's going to turn around for a while. Everything goes in cycles, and so it's not worth changing something that makes a lot of sense because you're in a short-term period of time where it doesn't make sense. And that's the catch-22 of investor sentiment. the emotional side of investing gets in the way of actual empirical evidence.
So the bottom line is stay the course, and if you can, buy.
Well, the bottom line is stay the course if the course you're on is the one you're supposed to be on.
Gotcha.
I mean, that's really the critical part about this is that for a lot of people, they have to figure that out themselves. They get suggestions from people, but they end up having to create their own portfolios. And so really trying to make sure that your portfolio is right for what you're trying to do, get your time horizon right, get your asset allocation. The biggest factor in success over long periods of time is how your money's allocated between asset classes. It's not security selection, it's not market timing. Over a long period of time, that is the Brinson B. Bauer study would say that it accounts for about 7% of your long-term result. 93% comes from asset allocation. So get that right, and then be okay with it when we have short-term bumps like this.